Hey guys, it's Max. Welcome back to the channel. I appreciate you guys being here. Let's take a look at these Defiance funds, and then we'll look at the YieldMax funds also, and then we'll see where we're at. We'll start here on Defiance, just like usual. Well, let's start on the USOY, which is the oil fund, since that happens to be the page that we have open. Okay, so on the spreadsheet, they've rolled all their options, all their strikes, 1,223 strikes to the 1,223 contracts to the 81 strike. They received 83 cents for it. Now, it doesn't expire till tomorrow. So max profit is, of course, 81 because that's where the break even is. Let's take a look at the chart real fast. All right, so here's the chart for USO. USO gapped down this morning, but is since recovering. So USO needs to get back. The price of USO needs to get within this box somewhere by tomorrow, by the close of day tomorrow, for us not to have a loss. So we're rooting for that price to go up. So now let's look over here at Triple QY. These guys trade NASDAQ options, NDX, and you can see right now we're right about halfway through the box, so we do expect about a half profit. So let's look at the spreadsheet. Triple QI. These guys sold the 2420 option for 110 points. All right, so right now it's 33 points in the money. So if we had to buy this back, it would cost us 33 bucks. Sold it for 110, bought it back for 33. The difference would be our profit, which would be 984,000. 29 cents a share positive on the month, and the dividend estimate's coming up. It's going back the right direction at 75 cents. So that'll work. JEPY, these guys sold options for $17.55. Right now, those options they sold are out of the money, so they could buy them back for zero, full profit. These guys made 27 cents a share so far on the month, and the dividend estimate is 43 cents a share, about halfway through the month. Here's the chart. JEPY. JEPY trades SPX options. You can see the SPX gapped up this morning and has been steady ever since then. It's now close to the highs for the day. So that's great. So now we can look at us IWMY. This is the Russell 2000 high yield fund. These guys sold their options for $15.59. Let's see what the market's trading at right now. Right now, these guys could buy their options back for zero, meaning the options are out of the money, because they sold the 21.95 strike, and the price of Russell's at 22.28. The price of Russell's blowing up, of course. Let's pull up a chart. It's an impressive chart. Look at that. That is crazy. Look at the size of this open gap right here, this open bullish gap. I mean, that's a huge imbalance, whatever happened right there. Gigantic imbalance. All right. So that's great. Now let's look at the YieldMax ones. The YieldMax funds will start Tesla. Now Tesla's just kind of chopping around today. Tesla really hasn't is trading at 250 last Friday or Friday the 5th actually. And it's trading at 250 again right now. Now it's gone up and down quite a bit in that time. It's been as low as 230 and as high as 270. But in any event, Tesla really hasn't much progress, and that's great for people that are playing the Tesla crash combo trade, which is where you buy Tesla and you buy crash. It puts you in the position of having an iron condor on Tesla. Iron condors do well whenever the market goes sideways. So people that have both of those options, or I'm sorry, both of those ETFs, they want the price to stay between the red box and the yellow boxes. Whenever prices go outside and above the yellow boxes or below the red boxes, that strategy's in trouble. All right. So now let's look at Coinbase. Coinbase has an inverse fund also called Fiat. So same thing here. Fiat's covered put strike prices are in red. So you can visualize them. Now, Coinbase, which is Coney, has blown out their strike. Yesterday morning, they blew out their strike, and they haven't rolled it yet. So we shall see what happens. We'll check out NVIDIA. NVIDIA's kind of been pulling back lately. They have a 2-strike ladder. They're in good shape. We'll check out Misty. So Misty trades Mr. options, MISTR. They look like Coinbase. They've blew out their strike. We'll see what happens. We'll see if they roll today. Let's also check AMD. Okay. AMD's pulling back, kind of like NVIDIA was. The chip stocks are pulling back. AMD has a 2-strike ladder. Doesn't expire till Friday. So they have plenty of room on the upside should the stock decide to turn around and go up. And we have AMZ. Of course, AMZ trades Amazon options. This one's also unchanged basically for the past couple of weeks. Even though it's been a lot higher, we're basically back to where we were, the end of last June, right around 195. So, but that's good for the covered call part of the strategy. Bad for the NAV part of the strategy, or neutral for the NAV. The NAV reacts to the price of the underlying somewhat, and the dividend, the distribution, reacts to the amount of premium or volatility in the underlying. So it means the amount of premium they're able to collect. All right. So what else do we have to look at? Let's look at this now. This is in my opinion, this is called a diagonal. It's a call diagonal, selling one call and buying another call. We're, what I think, taking advantage of a mispricing. This is in GME, and supposedly Roaring Kitty bought options in this stock. Well, I mean, I'm sure he did. So this is in play. Volatility is going crazy. So this trade doesn't expire till next Friday. This is a diagonal, and July 26th, which is next Friday, the short leg, which is a 40 call, which is crazy that a 40 call is going for more than $1 right now. That's crazy because GME stock isn't even trading at 30. That's a vol of 223. So you can sell that, but you can buy the 30 call for August 2nd as part of a diagonal trade, and it puts you in a nice little position. This call diagonal, I like this. I like this position. So these trades are long volatility. This trade, it's bullish and it's long volatility. You want the price of GME to go up and volatility to increase. Now, if the price of GME does go up, especially by a lot, volatility will likely increase also. And so then even if you don't hold it all the way till expiration, if you hold it, till Wednesday of that week, depending on where GME is, if GME is at 30, this trade's worth $154. GME's at 40, this trade's worth $500, and depends, or more, depending on where volatility is. Even if volatility stays the same, GME's at 30, this trade's worth $100. At 35, this trade's worth $380. Anyway, this is a nice way, instead of YOLOing. A lot of people would just buy the call, and we can simulate that. I'll just exclude this. And you could do this too, and there'd be nothing wrong with this. This would be more expensive. This would bleed money. It would cost $282, and it would most likely lose. When you're buying calls, you're paying time premium. It's kind of a sucker bet. But if you add in the short 40 call, there it is. If you sell this 40 call, you only have about half the risk versus just YOLOing and buying the 30 call. you do it this way, you have $282 risk, and you need GME to move 15% before you make any money. If you do it my way with the call diagonal, your risk is about half of what it is on the other, and you don't need GME to move at all to be profitable. If GME does move 15%, this way would make $225, where the last way would just be a break even. Of course, the last way is uncapped on the upside. So this way's capped, but it's not capped until you get to $40, and you still have a max profit of $800 on $170 risk. So I think it's a nice little trade. I don't know. Let me know what you guys think. All right. Have a good one.